Welcome to the Daily Update Podcast, where I'll go over the action in the market for Thursday, June 5th, and we'll see how things look for Friday, June 6th. To recap what happened on Thursday, the S&P 500 started the day with an attempt to push higher, but met resistance at the R2 pivot point and the psychological 6,000 level. Selling pressure took over in the afternoon, driving the index to close near its intraday low, down just over 0.5%. Trading volume picked up but still remained below average, signaling a lack of strong conviction among market participants. From a technical perspective, the S&P 500 is in a consolidation phase, moving sideways without a clear trend. Despite Thursday's pullback, the S&P 500 remains above its 20, 50, and 200-day moving averages, supporting a positive outlook across the short, intermediate, and long-term timeframes. Economic data released painted a mixed picture. Productivity fell 1.5%, worse than the expected decline of 0.8%. Unit labor costs rose 6.6%, above the forecasted rise of 5.7%. Initial jobless claims increased but stayed below critical levels of 300,000, while continuing claims saw a slight improvement. Notably, the trade deficit narrowed significantly to minus $61.6 billion, far better than the anticipated minus $117.2 billion. Market sentiment showed some divergence. The VIX climbed to 18.48%, reflecting increased volatility, but remaining below the 20 threshold. Investor sentiment rose slightly to 58 from 54, despite the day's decline, suggesting mixed signals. Short-term indicators such as the slope oscillator are negative, while intermediate-term momentum indicators such as the PMO and Arun show extreme positive readings. The ADX confirms a non-trending S&P 500, and the smart money indicators, including the Chaikin money flow, are hinting at emerging weakness. Sector performance was uneven. Growth sectors, particularly discretionary and tech, underperformed, while Tesla dropped a notable 14.26%. Communication was the only sector to end in positive territory, while staples weakened but held up relatively well. Among key stocks, Netflix reached another new all-time high, while Nvidia, Apple, and Tesla saw significant declines. Microsoft, however, outperformed with a 0.82% gain. External factors also played a role. Rising interest rates, with the 10-year yield at 4.39%, likely weighed on equities. News of trade talks between President Trump and Xi, a public disagreement between Trump and Elon Musk, and the European Central Bank's 25 basis point cut added to market uncertainty. Looking ahead to Friday, June 6th, the spotlight is on the monthly employment report, a critical driver of market sentiment. Economists expect 130,000 new jobs and a steady unemployment rate at 4.2%. A weaker than expected report could amplify negative sentiment, especially given recent signs of softening in the labor market. Later in the day, consumer credit will also be released, providing additional context on economic health. The market remains positive across short, intermediate, and long-term horizons, but it continues to lack a clear trend. Investors are likely in a wait-and-see mode ahead of the jobs report, which could spark volatility depending on the outcome. Seasonality for June 6th since 2002 is mixed. The Dow is positive, the S&P negative, and the Nasdaq is neutral to negative. Post-election year seasonality also suggests potential weakness over the next few days. For key levels to watch, please view the pre-calculated pivot points for Friday's session. In conclusion, the S&P 500's pullback on Thursday helped ease some overbought conditions, but the market remains in a consolidation phase with no clear directional trend. While the broader outlook is still positive, short-term weakness and the upcoming employment report could introduce volatility. Thank you very much, and I will talk to you in the next podcast.